The theme of this year's Milken Conference is advancing a thriving world. It's an optimistic take, but perhaps not unexpected for a man known for being a pioneer in the financial services industry. Few names in the world of finance are as evocative as Michael Milken. An investor in everything from private equity to venture capital, in the 1980s he rose to prominence for issuing the original high-yield debt instrument. Call it junk bond if you want. That's what many people do. He used them to finance leveraged takeovers and the so-called corporate raiders who rose to prominence at the time. In 1988, he was charged with securities fraud, serving 2 years of a 10-year sentence, and his absence led to the collapse of the junk bond market and his investment bank, Drexel Burnham. In a 2006 article, The Economist summed it up. Quote, junk bonds helped reshape and modernize corporate America, no matter how unpopular they were. He hit the headlines again in 2021 with his moves in the SPAC space, showing how shrewd timing made them just as valuable to him as the so-called junk bond trades of prior decades. More recently, he's been synonymous with global philanthropy through his Milken Family Foundation, the focus of which has long been education and the ability to influence policy. Yahoo Finance's executive editor Brian Sozzi spoke with him about turmoil in the banking sector and the latest developments in healthcare.
This is my 51st year of putting on these conferences, so this is our 26th at the Global. I think what you're seeing here is the playing out of interest rate risk. A lot of people focus on credit risk, but didn't really focus on interest rate risk. And the artificially low interest rates we had for a long time, you're seeing playing out in Silicon Valley Bank today and First Republic and other institutions where they borrowed short and lended long. You would think you would have heard all these things from the 60s, 70s, 80s, 90s, that we would have learned our lesson. And in the 80s, the highest rated banks in this country were basically in Texas, and none of them survived independently. But this is still a small sector of 4,500 to 5,000 banks, and the banking system itself has built up substantial equity and safeguards. So this isn't really an issue for the overall banking system. But the reserves they've set aside for credit losses, etc., they can absorb. The issue here is the mistake that anyone can make, having short-term liabilities and long-term assets. In the case of First Republic, heavily fixed-rate intermediate-term mortgages. In the case of Silicon Valley, heavily government and agency securities.
What do past banking crises suggest on what may happen in the future, especially as the Fed is still out there raising interest rates?
Well, I would say to you the banking system is substantially stronger today. We have a lot of banks in the United States, but you have a lot of financial institutions that have been built. During COVID, you had companies like PayPal or Visa or MasterCard that helped carry people over. Institutions like the IMF came in and supported 95 different countries in the world. What we're really seeing here is the playing out of those really that mismatched, borrowed short, they're borrowing at little to no cost, and bought portfolios that yield 2 to 3%. So there's 30 trillion in the world, and the largest holder of these assets is the Fed here in the United States.
How should the average investor who's on Yahoo Finance, should they be concerned by what they're seeing in the banking sector?
I don't believe so. You've seen both in First Republic and in Silicon Valley that all deposits were made whole. The average investor only has less than 250,000, which is all insured. And if you looked at, say, Charles Schwab, they have over 300 billion in deposits to start the year, but the average account was $20,000. So this is not the 1980s, it's not the 1970s, it's not the great financial crisis, but it's a lesson again that we need to match those that buy long-term assets with those that have long-term liabilities, like pension funds, insurance companies. And our financial institutions cannot run a mismatched book of short-term liabilities and long-term assets.
Is greater regulation the answer? Does that help that?
I don't think so. I think supervising, and I think we really forgot to look at interest rate risk. So you have a lot of analysis going on in risk. And the great financial crisis, probably the most amount of money was lost in AA or AAA securities, particularly related to real estate. So I don't believe that's it. I think understanding that you have to match your liabilities and assets, and the average bank is leveraged 8 to 1, 10 to 1. So if your assets go down 10% just due to interest rates, you're putting at risk, and you're really not serving what was the purpose of a bank, and that was to match your liabilities and assets. If you had floating rate assets, it wouldn't have made a difference. They would have gone up at that point in time.
And that was Michael Milken, Milken Institute chairman, alongside Yahoo Finance executive editor Brian Sozzi.